Hello, everyone, and welcome to Real Vision Live. For Real Vision, I'm Max Wiethe. We're joined today by Arjun Divecha, the head of emerging market equities at GMO. As well, he's a board member there, and he's been with the company for decades. Today, we're going to be talking about all things emerging markets. We'll get into some of those pressing questions that I know all of our viewers have, like where is the dollar headed, and are there any issues with emerging market dollar-denominated debt? But before we get into some of those questions, I want to just start out with a broader view from you, Arjun, on how you're seeing emerging markets and the macro environment in general.
Sure. Well, thank you, Max, for having me on. A real pleasure to be here. So basically, for those of your viewers who know GMO, one of the things you'll know is that one of our principal businesses is the asset allocation business, where we basically allocate money to emerging versus US versus bonds versus equities. So in our broadest kind of mandate, or something we call the benchmark-free allocation fund, we currently have about 30% of the money in emerging market equities, specifically in emerging market value equities, kind of the cheap part of emerging markets. And we have currently zero, in fact, less than zero effectively in the US market. So it kind of tells you what we are thinking, that we think that within the equity landscape, which we're not very bullish about overall, we think that emerging value especially is the one place to be, primarily because of the cheapness. So that's kind of where we're kind of starting out from. But obviously, there are complicating factors like the virus and how to think things like that, and we'll get into that.
So when you say that you're at about 30%, how does that compare historically, maybe with where you've been in the past few years? How overweight emerging market value is that for you guys?
So we have been quite overweight emerging markets for a long time, for the last 3 or 4 years, certainly. This is about as high as we've been. We're slightly lower than kind of the peak that we were at a little bit earlier because some other stuff in the world has become cheaper. So there was a time, if you look at January this year, where pretty much all equities in the world, except for emerging equities, were unattractive. And so we had almost nothing. And almost all of our equity exposure was kind of in emerging. Today, other stuff in Europe and Japan and other places have become more attractive. And so we have more exposure over there.
Okay, and you mentioned coronavirus and how that is affecting things. There is questions about whether certain emerging markets have totally avoided the virus, whether certain emerging markets are sort of waiting for their day of reckoning. How are you guys viewing the potential for second wave risk, or really first wave risk, for some of these countries?
Sure. So first of all, let me just say that our philosophy about how we manage money in emerging markets is a very top-down philosophy. That is, we believe that getting the top-down, i.e. getting the country right, is the most important dimension. So we spend a lot of time and energy figuring out which countries we want to be in. Now, in normal times, there are two dimensions that matter. That is valuation, that is how cheap is the country, and macroeconomics, is the country doing the right thing? And from a long-term point of view. What we have now added on a layer to in the short run because of COVID is kind of two other dimensions. So dimension one is how bad is COVID in that country? That is, how badly is that country suffering? And it's not just from a medical point of view, it's really from an economic impact point of view. That is, are the medical systems overwhelmed? Things like that. So that's one dimension. And then the second dimension has to do with macroeconomics, and specifically, what is the ability of this country to rescue itself? That is, how much dry powder do they have going into the crisis? So clearly, if they've got no dry powder, it's very hard to respond to a crisis. Whereas, as we've seen in places like the US, the dry powder is enormous. And we've seen that from the Fed and from.
Hi, I'm Raoul Powell. Sorry to interrupt your video, I know it's a pain in the arse, but look, I want to tell you something important. I can tell that you really want to learn about what's going on in financial markets and understand the global economy in these complicated times. That's what we do at Real Vision. So this YouTube channel is a small fraction of what we actually do. You should really come over to realvision.com and see the 20 or so videos a week that we produce of this kind of quality of content, the deep analysis and understanding of the world around us. So if you click on the link below or go to realvision.com, it costs you $1. I don't think you can afford to be without it.
The budgetary stuff and things like that. So these are the two dimensions we look at. And in fact, I have a chart, which if you can put that up.
Yeah, here, just one second. I'll get that pulled up here. All right.
So basically what you'll see here is in some sense, is the two axes. You see the kind of the vertical and the horizontal axes. And you'll see in the top right, the countries that are the most attractive right now from this point of view, which is basically Korea, Taiwan, and then China. And the reason why is because they have a very good ability to respond from a macroeconomic point of view, because they've got a lot of cash in the bank effectively, they have borrowing capacity, they have low deficits, et cetera, et cetera. And on the vertical dimension, they have actually done very well in terms of containing the virus. And in many ways, the first wave is kind of past them. Now, we're starting to see some worries about a second wave in China. So, for example, just today, Beijing closed all of its schools. So you may be starting to see a second wave. We don't know. But certainly we're trying to look and see, how our country is responding. So if you look at the bottom left, there you've got countries like Brazil, Indonesia, where things are bad from a COVID point of view, and their ability to respond because of their macroeconomics is actually quite poor. So in some sense, we're taking this framework and then we kind of overlay this on top of what we normally do, which is look at valuations and things like that. So net, the countries we kind of like right now are places like Korea, Taiwan, Russia, which we can talk more about in detail because Russia is extraordinarily cheap in addition to being pretty well off from a macroeconomic point of view. But overall, the theme that I'd like to talk about is the fact that this time around, emerging markets are better off in a crisis than they have been in previous crises. And I started in this business in '93. I started this fund actually in '93, and so I've been through a series of different crises. And in many ways, emerging markets are best positioned going into this crisis. Why are they best positioned? Most importantly, because economic risk is lower today in emerging markets than it has been in the past. Now you may say, why? Why is economic risk lower? Economic risk is lower for a number of reasons, but a big part of it is the fact that the emerging index itself is now got, if you just think of three countries, Korea, Taiwan, and China, are over 60% of the index. And these are all three countries that, from an economic point of view, are far more stable than some of the other countries. Latin America, which is in many ways some of the more unstable kind of part of the world, has gone from being 23 or 25% of the index a few years ago to only 6 or 7% today. So the point is that the mix of risky countries has gone down quite substantially versus the mix of fairly stable countries economically. So net, we think that this time around, even if we get a second drop, as I think is quite likely given the valuations around the world, it's very likely that we'll see another leg in the bear market. In that scenario, we don't think you're going to see the -50, -60% kind of returns that you got, in previous crises like in the GFC or in the Asian financial crisis.
So you gave sort of 4 countries that are in the green that you really like: China, Taiwan, Korea, and Thailand. Russia is the only one that you mentioned as one that you're very bullish on, but that isn't in that sort of green zone as safe for the COVID crisis. I think that's a great place for us to go next in how something doesn't have to be perfectly positioned for COVID, but can still be extremely attractive.
Yeah, as I like to say, you make more money when things go from truly awful to merely bad than when they go from good to great. Russia kind of falls into that category. That clearly it's not a great country from multiple points of view. The one point of view where it is actually pretty good is the macroeconomic point of view. And that is that people may not realize this, but Mr. Putin, for all of his legion, faults, which are legion, I would say has been over his entire career a fiscal conservative. That Russia runs very tight budgets in terms of does not run big surpluses. Again, because of oil, it runs big current account surpluses, has very little foreign debt, etc. So the bottom line is basically that from a macroeconomic point of view, Russia actually looks really good. Now you couple that with the fact that the Russian market, because of all the other problems, trades at incredibly low valuations, literally 5-6 times earnings. So going into this crisis, Russia was trading at about 5 or 6 times earnings, paying a dividend yield of 6 or 7%, and so, it is a place that we've liked a lot. And have, in fact, even today, something like 15% of the fund in Russia. And so the bottom line is that it is extraordinarily cheap. Now, it is suffering from a COVID point of view. And we are seeing that, in the news every day. And so, and I do think that they're fudging the numbers. So I think that things are actually quite a bit worse in Russia than the formal numbers suggest.
Well, that also brings up a question of time frame. So when you talk about being bullish emerging markets, what is the time frame that you're looking at, and what is the holding period for where you're looking to get some confirmation of that bullish thesis? How long would it be that Russia doesn't sort of see multiple expansion that you would rethink that Russia thesis?
So you asked multiple questions. So let me first answer the time
Yeah.
frame question. Um, Basically, one of the ways that we at GMO kind of look at our asset class forecasts is we make 7-year forecasts. And the reason is basically because it's very difficult to forecast stuff in the short term of 6 months to a year. So the idea is that the reason why we make 7-year forecasts is because what we find is that at the asset class level, when things are misvalued, that is, if the entire asset class, like emerging or the US, is trading too expensive or too cheap, etc., on average, it takes 7 years for it to cross its fair value line. So that's kind of been the historical pattern. So that's why we make 7-year forecasts. So the idea is that we believe if something is really cheap, it will mean revert to fair value over 7 years. So that's why I have no idea whether it'll revert in the next 6 months, which it could, or it'll revert over 7 years. So let me give you the example of the tech bubble. So going at the end of the tech bubble, if you look at January of 2000, for instance, our forecast for the S&P was minus 2.3% real for the next 7 years, i.e. that over the next 7 years, we expected that in real terms, you would lose 2.3% a year in the S&P. And our forecast for emerging was something like plus 10. What was the reality over the next 10 years? If you look at from 2000 to 2010, basically the S&P was down about 2.5% or something like that in real terms. And emerging was actually up 12.5%. So the fact is these things do play out over a long period of time. Now, if you looked at the next 6 months from that forecast, we were clearly wrong because the bubble continued for a few months before it broke. So I can't really give you a good sense for that. Now, coming back to Russia, I'm not so much looking for multiple expansion because a country like Russia should, in fact, trade at a pretty hefty discount. Because of all the risks that are legion in Russia, you should expect it to trade at 6-7 times earnings. So it's not so much the multiple expansion; it's more the earnings growth which filters through dividends and things like that. And the dividend yield, as I mentioned, is something like 6 or 7%. Now, clearly, in the short run, that'll probably get cut because of oil prices falling and will have some impact on their dividends this year, for example, and maybe next. But we certainly think that it will continue. Now, the reason why we're confident about the dividend, and this is one of the real ironies of the Russian market, is that a lot of the big companies, the oil companies, for instance, and the bank, are owned by the government. They're government-owned entities. And the government basically gets its revenue from the dividend flow of these companies. And the government has now mandated that all government-owned companies have to pay 50% of their net earnings out in the form of dividends. And that's why the dividend yields are so high. And so in an odd way, our interests as minority shareholders are aligned with the government's interests, to make sure that they receive their money.
Okay, so you mentioned banking and the oil sector. We had a viewer who asked, when we talk about EM, could we please specify a bit more about sector and company? I know that you can't talk about specific companies, so I'm just going to let the viewers know right now that
Sure.
we can talk about sectors, we can't talk about specific companies. But what particularly, why don't we start with Russia from a sector standpoint, is attractive to you guys?
Well, basically, the problem with Russia is that it's a very thin market. When you really get down to it, between Sberbank, which is the one big bank over there, and the oil sector, they make up 70 or 80% of the index. So, and then the remainder is some retail stuff. So, interestingly enough, in Russia, all three actually are attractive. The bank, Sberbank, is attractive. We think it's extremely well run. It is extremely cheap, and has delivered very good returns for shareholders in the past. The oil companies, clearly, again, are much more of a play on oil. But even there, the way that the Russian oil companies are set up in terms of taxation and stuff like that is that their sensitivity to the oil price is less than you would have for a Western company, because the government does in fact take a big chunk of the oil revenue. And so therefore, even if the price falls a lot, it doesn't have as much impact on their earnings as it would for a Western company. And then the retail sector, we think actually, especially the retail companies, just like with Amazon, you have companies in Russia which are benefiting from the online movement to online from offline. And Russia is certainly behind on that dimension. So we like that sector as well. So we like all three, actually. It's one of those countries where we kind of like all the major sectors in the country.
Now, is that emblematic of what you're seeing from other emerging markets? China is unique in its in its dynamics, but sort of with the financial sector, energy, or some sort of commodity, whatever it is, the commodity that is special to that country, and then you have a sort of growing middle class where consumer retail spending is just in a secular uptrend. Is that sort of capturing the thesis for emerging markets in general beyond Russia?
Yes, in fact, you mentioned something very important, and that is, when I was talking earlier on about the risks of emerging markets going down, uh, again, on that dimension, if you look back, 10 years or so, or in fact, just before the GFC, commodity companies in the form of oil, metals, things like that, were a significant part, 18-20% of the index. Today, they're only 4-5-6% of the index, versus the high-tech sectors, the technology sectors, both in Korea, Taiwan, India, places, and China especially. And in tech, I include the consumer type tech, like the Alibabas of the world, and I include the Indian software companies, which are, more, back office kind of companies, and the Samsung Electronics and the Taiwanese, manufacturers who make all the components for the iPhones and things like that. So, so that has become a much bigger part of it. So coming back to your question on China, one of the cool things about China is that it is such a big and diverse market that you can really treat it as different markets. If you think of the Alibabas, the JDs, the Tencents, all of those, they have benefited, in fact, from the crisis. And in many cases, a lot of these stocks are actually at all-time highs, because just like with Amazon, they've benefited from the shift from offline to online. On the other hand, the consumer sectors are still struggling. If you look at retail in China, clearly struggling, and that's going to struggle. If you look at people like who are mall operators all around the world are struggling, and they will struggle for a while to come, and maybe forever. Who knows? So you can really make those kind of distinctions in a place like China. And again, in China, they have their own banking sector, which has got its own unique characteristics because most of it is government owned. And so, unlike Western banks, Chinese banks, in some sense, are they're not too big to fail. They're just simply too government-owned to fail. So they can't fail. The downside is that to what extent will they be called on to do what we call national service, by the government in a crisis? The banks clearly become a vehicle for funding stuff. And it's never clear whether that funding comes out of the government's pocket or whether it comes out of the shareholders' pocket.
Okay. We actually got two questions about Russia. One question is, of the green countries you mentioned, a lot of them are relatively safe for capital. I think he's talking about, reappropriation of capital from emerging markets. When you think about Russia, how do you factor in that risk?
I think that the risk in the past has been real. You had the appropriation of UCOS, for example, where the government effectively took over one of the oil companies. But in my experience, and I've been investing in Russia since '95, I believe, fairly extensively, we've never had a case other than UCOS, which was really terrible from the appropriation point of view. I believe that, and even in the case of UCOS, I would say that that takeover was a political takeover, not an economic takeover. It wasn't that the government was taking over this company because they wanted to grab the assets. It was much more because Mr. Khodorkovsky, who was the CEO, was challenging Mr. Putin, from a political point of view. And so it had much more to do with politics. And that kind of era has passed. None of the CEOs in Russia today basically have any power at all politically, and nor would they dare to threaten Mr. Putin in any way. So I think the appropriation risk is fairly low. I think the risk, which is appropriately high and is in fact priced in with the valuation, is the lack of transparency, which is that you don't really have any idea what's going on in some of these cases. Some of the companies, you have very little transparency. But markets do a good job of pricing these things. And so the only issue really is that, is the price you're paying right now too cheap or too expensive relative to that risk?
Okay. And then another question about Russia is related to commodities, and commodities are just historically low in their prices. How much is the emerging market bet that you're making coupled with a commodity reflation trade? We can discuss it in terms of Russia and then also more broadly in terms of emerging markets, because commodities and natural resources do play such a large part in a lot of their economies.
Although the point is that they've become much smaller. It's only 6 or 7% of the index today. versus 20%, north of 20%, back in the early 2000s. So clearly the dependence on resources has gone down a lot, and so therefore we don't spend a lot of time worrying about that. That's not a big part of our thesis. The reflation of commodities is not part of our thesis at all. In fact, we make no forecast about the price of oil. In fact, when people ask me, what do you think is going to happen to the price of oil? I tell them that, I'm a militant agnostic. I don't know, and you don't either.
Yeah.
So bottom line is that no, we're not betting on a reflation trade and things like that. At the end of the day, we have no idea what's going to happen to oil prices. The good news is that from the point of view of, if you think about in emerging markets, where are the big energy producers? The two big energy producers are Saudi Arabia and Russia. And in both cases, they are the low cost producers. The lifting costs, both for the Saudis and for the Russians, are in the single digits. That is, the cost of actually producing oil is only $6 or $7. So yeah, they need more than that to run their budgets and all that kind of stuff. But from a pure profitability of the oil itself, as opposed to, let's say, in Brazil, their lifting costs are $70 or $80, or the Canadian tar sands. So the fact is that, if you're going to start shutting down capacity because of global warming, whatever happens, the fact is they'll be the last man standing, because effectively they're the low cost producers. So again, we're betting more on that phenomenon than a reflation trade.
Well, you did bring up a point about that there are sort of two costs that matter. One is the cost of production to be able to raise that oil out, and the other is the cost at which that country balances their budget. And for countries like Russia and Saudi Arabia, it's much more important. Russia has, I believe they have a sort of rule where when oil is above $40 a barrel, some of that money goes into a fund. Saudi Arabia, not so much. And you've seen actually Saudi Arabia's FX reserves going down over the past few months as we've had oil prices fall, whereas Russia has maintained itself as pretty steady. This is maybe a good segue for us to get into currency risk, because that is always important here in emerging markets. Why don't we start with Russia, as that's kind of been a talking point for us today. Do you see currency risk in Russia? And then we can talk about more broadly.
Actually, no. I think that the woman who's the head of the central bank has done a phenomenal job. I think she's a really amazingly good central banker. And so the currency policy in Russia has been extremely well run. There was a time when it was completely linked to the oil price. Basically, if the oil price went up or down, the currency kind of moved with it, so that in ruble terms, the price didn't move. That's not true anymore. Today, they have a much more sophisticated policy, and they've done a very good job of implementing it. So we don't see Russia, the currency, being particularly, vulnerable, because again, there's no vulnerability from the point of view. They're running big surpluses. They've got, as you said, a lot of money in the rainy day fund. So therefore, their ability to kind of balance the economy, and therefore, any kind of risks to the currency are very, very low. But why don't we talk about currencies in the broader emerging markets? Because at some level, when you invest in emerging markets, one of the big fears is that you have real loss of capital because of depreciation of currencies. That has historically been true. And so I actually have a chart, which if you want to pull it up, I'll talk through it.
Just 1 second here. We'll get that pulled up.
I'll talk while you're doing that. So basically at GMO, one of the things that we do is we have a model which basically looks at how cheap or expensive our currencies, for every currency. So what you see here is how cheap or expensive are all emerging currencies put together. So this is kind of the average of the 7 biggest emerging markets currencies, and how cheap or expensive are they. So the scale is kind of how many sigmas, or how cheap or expensive you are. So if you're above the line, you're expensive. If you're below the line, you're cheap. And again, for those of you who are technically kind of inclined, this is a purchasing power type model with a productivity adjustment, or also known as the Balassa-Samuelson effect. So when you look at this, basically, you'll see that today, the emerging markets currencies as a whole are very cheap. They're like 1 and 1.5 sigmas cheap. In fact, the cheapest we've seen in this entire history. So that's why at this point in time, we are not really worried about emerging currencies. Because if you think about it, they've already taken a hit. I mean, Brazil, already you've had the currency down 30%, and a number of other places like that. So you've already taken the hit to the currencies. The question is really, are they from a fair value point of view cheap? And they certainly appear to be so. So there's clearly differentiation between one place and the other. So for example, in Taiwan's case, the Taiwanese dollar has actually appreciated a couple of percent versus Brazil has appreciated something like 30 or 35%. So again, so the second message, if I were to leave you with something, is that emerging markets are not monolithic. That basically you need to treat these countries individually because their fortunes are very, very diverse. And the COVID crisis has kind of driven a spike between that diversity.
So that's actually a question that somebody had about some diversity. So you made it pretty clear that in general, emerging markets it's not an end all be all to be able to play that reflation trade. If you wanted to play some sort of commodity reflation trade, are there any emerging market economies which are poised maybe to take that? Maybe they're a smaller part of the index, so if you're just buying the index, you're not going to participate in that. But if you wanted to go country by country, what are some of the countries that you could participate in that trade?
So are you talking about a high beta trade? That is, if the markets all go up, they're the ones which are going to go up the most, or are you talking about purely a commodity reflation here?
Purely commodity reflation. The high beta trade is interesting, and I think it's worth discussing. But we got a question specifically about commodity reflation.
Well, the commodity countries really are Russia, South Africa, Saudi Arabia, Mexico, and to some extent Brazil. Those are the real commodity producers. Apart from that, most of the other big countries like India and China, Turkey are all consumers of energy and other commodities. So I'd say it's really those are the countries to play. And the good news, as I said, is that Russia is pretty cheap. So if you wanted to play the price of oil that way, that's a way to play it.
Okay. Well, some of the countries you mentioned, India and Turkey, are sort of in the white zone of less risky but lower ability to respond to COVID crisis. I think maybe rotating in that chart you brought earlier into how you're thinking about those countries they're not in the low ability and low risk category like Indonesia, Brazil, and Mexico, but they're still not in that safe zone. How are you thinking about those countries?
So first of all, let me say that what's happening in India right now, I mean, the chart was produced maybe a week ago, but things have really spiked up pretty badly. So if you look at cities in India like Bombay or Delhi, things are really quite bad. So in many ways, because they opened up and basically it caused a huge spread. So, I think that India would in fact not be in that white zone. It would be probably in the red zone today. I would say that all of those countries, from our point of view, the good news is that we didn't like them going into the crisis. That is, we thought India and Brazil were expensive. They're countries that we were not particularly bullish on, going into the crisis itself. And so therefore, the fact that they don't have the ability to respond, and remember, it's not only ability to respond, it's also competence. I mean, if you look at what Mr. Bolsonaro has done in Brazil, it's a disaster, So it's also a lack of competence in how you handle things, So, that's another dimension you have to worry about for each country is that, yeah, you may have the ability to respond, but the fact is you may just completely screw it up, So I'd say those countries are more vulnerable. Turkey, India, Brazil would be countries that I consider to be more vulnerable. And again, they were not super attractive to us from a valuation point of view, although Turkey is pretty moderately priced.
So we've talked about emerging markets as being cheap, and you and I actually discussed this a little bit yesterday in our pre-interview. I'd love to get a better definition from your end of what does cheap mean for emerging markets? Because you can go and you can find, I gave the example of Iran trading at 3 or 4 times earnings, and that's still not cheap enough for some people. So what is cheap to you guys?
So again, perhaps if I could use a better word, I could use the word attractive, because attractive includes 2 things. It includes the cheapness and it includes the macroeconomics in terms of are they doing the right things. Well, let me give you, if you don't mind, I'm going to back up and give you my thesis about investing in emerging markets in the first place. Mm-hmm. That is, I spent a lot of time thinking about why is it that some countries are rich and some countries are poor? And what is it that allows a country that's poor to become rich? And what I figured out is that while there are 100 idiosyncratic reasons for each country, there is one common factor amongst the countries that become rich. And that common factor is the strength of institutions. The countries that build strong institutions that can survive long periods of bad government are the ones who basically succeed. Because at the end of the day, to become rich, you need to compound growth. And so therefore, if you have high growth for 3 or 4 years and then negative growth and then again high growth, that doesn't get you anywhere. You need to have steady compounded growth. And what allows compounding of growth is the strength of institutions that the institutional nature holds. I mean, look at the US. No matter whatever you might think about any government, when you look at a chart of the GDP of the US, even the depression looks like a little blip. Why? It's because at the end of the day, the strength of the institutions is so strong that that people have the confidence to invest and people to spend and things like that. And so therefore the economy keeps growing at a very consistent rate for a long period of time. Whereas in emerging market, that's not true. In fact, I consider that to be the main difference between emerging and developed markets, that emerging markets don't have institutions that can survive long periods of bad government. So therefore, they're very dependent for their growth on the quality of the government that's in place at that point in time. And what that means is that you should never think of an emerging market as a long-term bet. You should never buy a country and say, I'm going to own it for 10 or 15 years. You basically need to get in and you need to get out. As I like to say, in emerging markets, you should never fall in love. You should only date, and you should date promiscuously at that. So given that kind of view of the world, the fact is that you want to get in and out of countries based on two things. Number one is cheapness. So again, those are the two dimensions I'm talking about here. So the cheapness, that is how attractive is something from a cheap point of view, and are they doing the right thing from a macroeconomic point of view? So now, to get back to your original question, what do you mean by cheapness? So the way we define cheapness is basically, we obviously have kind of sophisticated models to come up with those things. But essentially, it's a question of figuring out things like, it's a combination of multiple factors. And you can think of these factors as being valuing a country, or all the companies that are listed anyway, from two broad points of view. That is, how much are you paying for the cash flow, and how much are you paying for the earnings, and how much are you paying for the book? Now, clearly, over the last few years, as accounting standards have changed, and as more and more companies are, virtual companies like the Alibabas and things like that, book value doesn't mean anything. So, if you go back 50 years, in the Graham and Dodd kind of era, book value meant something because in some sense that was the tangible thing that companies actually had. That's not so much relevant anymore. It still matters a little bit for certain industries. So, for example, book matters for banks, for instance, because that's something tangible for a bank, but it means nothing for an internet company. So again, you have to kind of have valuation models that are based on what matters for those kind of sectors. And as I said, it's really cash flow and earnings, and kind of discounting those cash flows to the present and saying, and that's what you're kind of looking at. So if I had to reduce it to a simple number, I'd say, yeah, look at the PE of a country. For somebody who's, who doesn't have access to these kind of sophisticated models, I said, just look at the trailing PE ratio. That's a good indicator of cheapness.
So I did want to actually drill down on one thing. So you talked about, is the country doing the right thing? What's an example of a country that's doing the wrong thing? It's really obvious in the case of how they're handling COVID, but let's say we're in a world where we're kind of past COVID, and that's not something that a country can bumble anymore. What are the types of things that if you see from the government or from the monetary authorities that have you saying, I need to stay away from that country?
Well, let me give you an example of a country that used to be an emerging market, which is now a complete catastrophe, and that's Venezuela. Okay. When I first started my fund, in '93, Venezuela was actually a decent part of the index, and there were kind of interesting companies to invest in. But what has happened is that the government in that case has continuously made the mistake of essentially printing money, that is as a populist measure, that every time that there was some kind of a problem in the country, they just printed more money, and therefore they completely debased their currency. They ran massive both current and massive deficits. They basically had to get bailouts from people like Russia and China and Cuba and places like that. Even though they have, if I'm not mistaken, either the biggest or the second biggest oil reserves in the world. Okay, so this is a country by any standards should be one of the richest countries in the world, and yet through sheer mismanagement has basically become one of the poorest countries in the world. So the fact is that it's easy. So I'd say that is the most primary way that you debase your country, is essentially through money printing. So if you have inflation, you just keep printing money. You don't take the hard lessons of being fiscally prudent. So there are many examples of that.
Well, and is that part of the thesis as to why emerging markets look so attractive? That's happening in the developed markets right now. Everybody is printing. And so how are the emerging markets going to outprint the big boys? Is that sort of the part of the bullish thesis?
No, I mean, in a crisis, the ability to print really matters. Again, in many ways, we're in uncharted waters. I mean, if you look at all the money printing that's happening in the developed world, I mean, look, at the end of the day, if you think about what the Fed is doing in this country, we're trying to avoid what happened in the Depression. At the end of the day, what happened in the Depression is that because the monetary authorities did not, in fact, respond, with big size, what eventually happened was what started out as a liquidity crisis became a solvency crisis. So you could say that what the Fed is really trying to do is to avoid a liquidity crisis, which will then become a solvency crisis. So that's the issue. So again, who knows what the long-term consequences are? It may be that giving a bunch of companies that have too much debt, even more debt, is not in fact the right solution from the long-term point of view. But in the short term, it keeps them alive, and maybe that's more important. Now, that won't happen in places like India because India doesn't have the resources to, in some sense, give that kind of money to these corporations and people like that. Now, is that a good or bad thing? It may be a terrible thing. It may be a terrible thing because these companies may die. It may cause all kinds of problems for them. So that's why I would not be too harsh on judging Western authorities right now for what they're doing. None of us know how this is going to turn out, and none of us. I mean, remember, even today, 100 years on or 90 years on, people don't agree on what caused the Great Depression and whether they did the right things or not. So we may never know whether what the authorities are doing is the right thing right now.
Well, it is in a sense, it is extending the life of those institutions. So what you were talking about is being important for emerging markets and the reason why developed markets have been able to grow such tremendous wealth is by preserving institutions. And
Right.
and in all intents and purposes, backstopping these companies is doing just that.
That's right.
There is one institution which has had a long and strong run, and that is President Putin. His term comes up in 2024, and Cindy wants to know, is that a strong institution that you think will continue to 2024 and beyond?
Yeah, in many ways, it's a very good question because one would have thought prior to this crisis that that Putin's brand was so strong within Russia, and his strength was so firmly ensconced that there was no chance of any kind of weakness, and that Putin would never actually leave. That has been kind of my working assumption. My working assumption is that Putin will never, in fact, leave. He can't, because if he leaves, who knows what the next person will do to him and his family and people like that. So therefore, it's a classic problem with the dictator. The dictator can't leave because if he leaves, then he's basically vulnerable. And so that's why I think Mr. Putin can't afford to leave. Now, this crisis has actually put a severe dent in his popularity. Now, it's not clear whether it'll be enough of a dent to actually weaken him to the point where somebody can challenge him. We don't know. It's too early to tell. But he's got this referendum coming up in the next few months, which effectively is going to be a referendum on whether he should stay for life or not. And from what I understand internally, the metric that he is looking for is what they call the 70-70. That is, he wants 70% turnout to give him 70% approval, which means that 50% of the population actually voted for it. 70 times 70.
Yeah.
So we'll see. I mean, my money is on yes, he's going to survive.
Okay. Well, another country that maybe not as egregious as Venezuela that Jackie wants to know about is Argentina. Are they on your no-touch list?
They're not on our no-touch list. They're on our be extremely wary list. As I said earlier, everything is cheap at a price. So the question is, what do you pay for it? And I'd say that right now we have almost nothing in Venezuela. I mean, it's less than 0.5%. So the bottom, I mean, in Argentina. So I just think that right now we're not super bullish. I mean, they've got this kind of fight going on with the creditors and trying to work out kind of a debt deal and stuff like that. Some deal will eventually get worked out. It may not be good for the country, but at the end of the day, they are serial disappointers. When one has, one is kind of continuously disappointed in what's happened. So therefore, it's a country that you, more so than others, you want to get in and out. So i.e., when stuff is really cheap, you want to buy it, but when it gets above fair value, you want to sell it. You don't want to own it for a long term.
Okay. Now, one question we have here, it's really two questions that I think are kind of combined. C wanted to know about frontier markets. So that's sort of pre-emerging market. So it's a country
Sure.
that really doesn't qualify as an emerging market yet. And then Cyrus wants to know if there are any sort of diamonds in the rough. Are there these
Sure.
emerging market countries that nobody really talks about? Maybe they're technically sort of more like a frontier market, but for whatever reason they've reached the size that we consider
Sure.
them emerging. Are there any up and comers that people should
Sure.
be paying attention to?
Very good question. So first of all, let me tell you my view about frontier markets. So the distinction between frontier and emerging is kind of an arbitrary distinction. It's really based on, because the indices are kind of constructed. There's a developed index, there's an emerging index, there's a frontier index. So in some sense, the index providers create these distinctions. In my mind, the distinction between emerging and frontier is liquidity. That basically frontier countries are simply emerging markets that are much less liquid. That is, the ability to trade, to get your money in and out, is just much more difficult. So when we invest in emerging markets, we don't make that distinction. So we have money in Vietnam, we have money in a number of the countries which are considered frontier markets. We don't make that distinction at all. As long as we can buy stuff, and because obviously as institutional managers, size matters. So coming to the second part of the question, are there diamonds in the rough? I wouldn't even call it in the rough. I'd call it a diamond in everything, and that's Vietnam. I am very, very bullish on Vietnam as a country. The problem is that the stock market is not easy to invest in, and doesn't, in fact, represent the true, opportunity set of the country. So it's a very illiquid country. A lot of the stocks that are listed are state-owned enterprises, which are not that attractive. But yet, I was very bullish on Vietnam even before the COVID crisis, because you could think of that from the point of view of the trade war. Vietnam was the single biggest beneficiary of the trade war, because essentially where people are looking to diversify their supply chains, Vietnam was kind of one of the obvious places. Why? Because they have a young, very well educated, 90%, 99% literacy, okay? Very well educated, young population, very hardworking, and they've really built the infrastructure. If you drive, for example, from Hanoi to Hafong Bay, it is just one continuous set of factories and ports and docks, and the infrastructure has really been built out quite well. So something people may not know is that Samsung has shifted all of their cell phone production from China to Vietnam, and we just saw recently that Apple is planning to start making the earbuds, in Vietnam as well. So I'm very bullish on Vietnam. Difficult to play it. That's the problem. It's very difficult to kind of get access to it, and especially to the interesting parts of the economy. So that's one diamond in the rough. The other one, which has done surprisingly well, has been Bangladesh. That it has taken a fairly decent amount of market share on the textile and clothing market from China, on the lower end especially. You would think that India would have been well positioned to take that, but quite frankly, Bangladesh has really stolen India's thunder completely on that front. And in many ways, it's because they've kind of focused on that and done a good job of kind of creating the incentive structure for people to do that.
So when you talk about lack of access, is it just because the companies are too small? Is it maybe something that emerging market venture is able to get into, but it's not something for you guys who are looking to trade publicly traded stocks?
Probably true. Probably both. I mean, it's the fact that a lot of the interesting companies are not actually listed on the stock exchange. So going through either private or venture might be one way to access them. Or secondly, the ones which are listed are too illiquid, so you can't actually buy any kind of size. Or that a lot of the listed companies are in fact state-owned enterprises, which don't represent good opportunity from an investor's point of view. So it's all three of those which kind of make it difficult to invest in.
How much does a developed private market ecosystem help a country on the public side? So if there are VCs and private investment in there, maybe not something that you can participate in, but it helps the total environment for you guys. Is that something that you look at? Is private money going in when you're making these sorts of decisions?
It's a really interesting and complicated question because yes, it should really help because in some sense you would say that would be the feedstock for what we would own, as these things can go public because they kind of nurture companies to become bigger and eventually go public. But in practical terms, in places like India and in China, I mean, in China it's a little different, but in India, in some ways it has been a substitute for the public markets. And so a lot of the interesting newer businesses in the last few years have remained private, just like in this country, and not gone public. And so there's a lack of kind of fresh companies on the stock market. A lot of the companies in India that are listed are companies that are old world kind of companies and not so much new world stuff. I mean, that's changing, obviously. But clearly, there has been quite a boom in venture cap in India, especially money going from this country to India. But a lot of them have stayed private, and our hope is that we'll start to see some of these lists, over the next few years.
And how do you guys think about participating in public offerings in emerging markets as opposed to maybe looking at newly listed stocks in the developed markets? Is it any different, or do you sort of treat it the same way?
It's a question of the level of transparency that they have. I mean, increasingly, the transparency is just as good. I mean, look, we live in a global world, and so therefore, when a company in India or China wants to go public, there's a lot more disclosure than there used to be in the past. Now, I know that, for example, the SEC is kind of, making a big fuss about perhaps banning Chinese companies from the US market if they don't kind of open up and are much more transparent. And I'm all in favor of that. I'm all in favor of greater transparency. I mean, at the end of the day, people like us make our money through transparency, that is knowing the real situation and analyzing it. So, but I would say that it's a lot better. There was a time, when I first started out in the 90s, when there was a lack of transparency. I still remember there was this one big Pakistani company that went public, and effectively refused to give anybody their financials. It was like, wait, you're going to go public, but you're not going to tell us what your financials are. So that day doesn't exist anymore. Today, you couldn't do that. You couldn't get away with that kind of thing today.
Okay. And yeah, that's a pretty obvious example of a company you want to stay away from. It's not like there's anything intrinsically, it's just so obvious that that's a company that you would want to stay away from. So not too hard to miss. Sure. I did want to let the viewers know we're kind of coming towards the end. So if you have any questions, now would be the last time to get them in. But I did want to touch on two topics that I know are extremely important to our subscribers. And they are very related in this context. One is dollar-denominated emerging market debt at the corporate level. And two would be just the dollar in general, because the cycles of the dollar is so tied into emerging market performance. So I think better would be to start out with just your overall dollar view, and then we can move into how some of the dollar debt in the emerging markets is potentially either overblown or whether it is an actual risk.
Sure. Yeah. So I kind of addressed the first question, with the chart which I showed you, which is how cheap are emerging market currencies, because that's the opposite of how cheap or expensive is the dollar. So clearly, if emerging markets currencies are really cheap relative to the dollar must be expensive. So our view is that the dollar is in fact overvalued, especially relative to emerging market currencies. The problem, as always, is that in a crisis, there's always going to be a flight to quality, and the dollar is the highest quality asset that exists. I have clients in Brazil who are very rich families, and when the crisis hit, I asked them, I said, well, what are you guys doing with your money, or what do you want to do with your money in this crisis? And they said, we only want two things. We want dollars and we want fangs. I mean, that's what happens in a crisis. Everybody wants to go to the safe place because they're worried about what's going to happen in their own country, whether the assets will be devalued, et cetera, et cetera. So clearly in the short term, even though the dollar is expensive, it's very hard to make a prediction in a crisis like this. Coming to the second question about dollar debt. So yes, dollar debt has in fact risen a fair amount, but there's two statistics which are important. One is that as a percentage of GDP, dollar corporate debt in emerging markets has stayed fairly constant, about 12, 13, 14%, something like that. So yes, remember, dollar debt has gone up in absolute terms, but remember, the economies have also grown that much and the companies have grown that much. So therefore, as a proportion, it isn't really very much higher. Secondly, the other thing to really think about especially in this particular regard, is that how much of their debt is actually dollar debt. So if you think about how much is domestic debt versus dollar debt, remember, domestic debt is much easier to pay because in some sense it's denominated in the currency that you receive, your payments. So on that dimension, things have actually gone the other way. That is, if you looked at what proportion of corporate debt in emerging markets is local versus dollar, it used to be about 80%. 80% is local, 20% was dollar. Dollar, I mean foreign, okay? I mean, it could be euro, anything. And today it's actually risen to about 86%. So in many ways, dollar debt has gone down from 20% of overall borrowing to only 14% or so. So again, a little bit safer from that point of view. So that's why we're less worried. The other one, even further confounding factor is the fact that if you look at where does the dollar debt actually exist, a lot of the dollar debt actually exists in companies like the oil companies whose revenues are actually dollar based. So again, if you have dollar debt and you have dollar revenues, it isn't as much of a mismatch. If the problem is if you have rupee, revenues and dollar debt, that's the problem.
Okay.
So that's why we're not quite as worried about it as but people seem to be.
Okay. Well, we got two questions that are related to two pegged currencies. So Cindy wants to know whether you think there's any risk of Saudi unpegging their currency, and also maybe I'm reading this one incorrectly, but it looks like she's also interested in whether you think they're conducting all of their business in dollars has any risk of changing. I mean, we have the yuan oil contract, which is exchangeable for gold. Is that something that you pay attention to? Maybe a shift in how the world conducts their business in dollars?
Very good questions. On the first one, I don't think they would like to. I don't think they want to get off the dollar standard. The question is that if, as you pointed out earlier on, one of the problems that the Saudis have is that if oil prices stay low, it really blows a big hole in their budget. And so therefore, if that continues for years, I mean, if it's 1 year, no big deal. But if it's 3, 4, 5 years where oil prices stay low, in that case, clearly they cannot afford to kind of stay on the dollar standard. They would need to devalue just for their own reasons, So I think that I don't think there would be any intention to do so. I think they would be forced by market forces to do so. We don't know that. It really depends on what happens. If oil prices go to $50 and stay there, that won't be an issue. The second question is an even more interesting one, which is that you could ask it's a really big question, which is that how supreme is the dollar? That is, is there any real threat to the dollar? I think in the long run, there is a threat to the dollar. I mean, partly because of actions that this country has taken to kind of reduce the dependence of the world on the US. And so clearly there's a desire by multiple parties to have less dependence on the dollar. Certainly the Chinese want to be less dependent on the dollar. The problem is that what are you going to move to? I mean, for a while there was, back in the early 2000s when the euro was first introduced, that everybody said, yeah, the euro could become, the new dollar standard. But look, I mean, it's very clear that they don't have the cohesiveness for that to really be the case, nor do they intend for it to be the case. The yen, no, not really. So clearly the people who would like to be an international currency is the yuan. The yuan would be kind of the natural kind of one to be a. But at the end of the day, they have a closed capital account, okay? You can't be an international currency if you have a closed capital account. Let's be clear about that. So they need to open up their financial system. They need to make massive reforms to their financial system. They need all these things to happen, which will take years to come before they could even really be a threat to the dollar as an international currency. So will you have some contracts which are denominated in yuan? Yes, but as to replace the dollar as kind of the lifeblood of the flow of economies, no.
Okay. Well, Jackie actually had a question about RMB. She's saying that some investment banks are recommending Chinese RMB bonds. Is that something that that you would be cautious of, or something that you might consider? I know bonds are not your purview, but just related to currency risk with the RMB, I think more generally is what she's looking at. I think she's taking a skeptical view of those sorts of offerings and recommendations.
Well, I don't think that you could go disastrously wrong by owning RMB bonds, because at the end of the day, the RMB is not going to fall out of bed. Now, is it a good idea? I have no idea. I'm not I'm not a bond guy, and so I have no idea whether. Again, it depends on how it's priced and all that, and I have no basis whatsoever to know, whether it's a good investment.
But from a general currency risk perspective, you don't see it as tremendously just an egregious risk.
No, it's not.
Okay. All right. Well, we got one last question from Kavi, who wants to know about specifically the gas sector in India, pipeline and distribution over the next decade. Do you have any views on that sector in India specifically?
I will confess I know nothing about it.
Well, you know what? That's better than an answer based on nothing. So thank you for your humble honesty. Yeah, we don't have any more questions. I mean, if there is a sort of a summary that you would like to give of your view on emerging markets as they are right now, I think that would be a great way to tie it up. But if not, I just want to say thank you.
Sure. I'll just briefly summarize by saying that, look, we live in a very, very uncertain time. And from where I sit, at the end of the day, I want to own assets that are cheap. And the reason I want to own assets that are cheap, because at the end of the day, the amount of money that you make on anything is a function of what you pay upfront for it. When you overpay for something, you basically lose money. When you underpay for something, you make money. In fact, if you don't mind my saying why I'm a value investor, it's basically because I believe the opposite of value is the way to think about it. That is, human beings will reliably overpay for two things. Human beings will reliably overpay for sexiness, and they'll reliably overpay for comfort. Buying the fangs is basically sexiness, and buying, the dollar, you could say, is comfort. And in many ways, what we do is the opposite. We buy Russian oils, which are dangerous, and we buy Thai telecoms, which pay high dividend yields, which are boring. So we buy boring and dangerous as opposed to sexy and comfort. Thank you.
Okay. All right. Well, Arjun, thank you so much for joining us today. It has been an absolute pleasure, and we hope to have you back and maybe some of your other colleagues at GMO.
We'd love it. Absolutely. Thank you.
Thank you for watching this interview. This is just a taste of what we do at Real Vision. To learn more about the complex world of finance, business, and the global economy, click on the membership link in the description. Give us 7 days to change your life. This will be the best dollar you ever invest.